Hello, World Wide Web. Good day and good morning. This is James, your favorite stock guru. Please like the video, subscribe to my channel. We got some news on Troika Media Group, TRKA, up almost 19% on the day. This one's bouncing around, making everybody crazy. It's hot on the short sellers list. The company is Corson. We've talked about this one. $400 million a year. They're now a profitable company. Annually speaking, they didn't make money in 2022. Quarterly speaking, they made money in the final quarter of 2022, and then they just released another earnings report with another win. They actually made $5 million for the year. They are right side up. The company's balance sheet, just to take a quick peek at it, so everybody gets the idea, it's right side up. They paid down some debt, which is nice to see. Year over year, this looks like a brand new asset, $204 million versus $193 million. So they are right side up. They're a profitable company. They should have a positive PE coming up and an earnings per share pretty soon, 24 cents a share. Troika Media Group was a big do-nothing company for a very long time. It bothered people almost to some extent. Actually, this is some of their bad charts from the last year. Just getting destroyed all year long. Business-wise, annually, you can see year after year after year, just, this isn't growth, just losing money. Everybody got disenfranchised. They went public. They didn't really have anything great going on. They did what they call a reverse merger with Converge. Converge is another company that was a private company. And instead of Converge going public, they decided just to be acquired by Troika Media Group. And I wanted to explain that story to everybody. How did Troika Media become a penny stock? This is a very interesting article that explains it perfectly. First, some background on Troika's reverse merger. In March of 22, Shell Company, a company that does nothing, pretty much what we just looked at. And you got to watch out for those on the internet. Sometimes they're really scary to invest in, especially if you're paying a bunch. You might think it's going to be something, but it never really was going to be until they decided to make it one. In this case, they're going for it now. Troika Media bought out Converge LLC, a customer acquisition and marketing firm, generating around $300 million in revenues and $23 million in adjusted earnings per share. EBITDA. It's a great company that they bought out. They bought it for $125 million. It seems like they got very good value for their money. They're putting their revenue on their balance sheets now. Looks fantastic. That's where that came from. What I really like about this Converge company is the business that they're in. Customer acquisition and marketing firm. These people are professional marketers. They're good at getting customers. This is good. They could have bought a toy company or somebody who didn't know how to do marketing, but they actually went and got marketing professionals. In Wall Street, these reverse mergers are an ordinary part of business. Companies like Converge know it's expensive to list on an exchange like NASDAQ, so rather than hire a top-tier investment bank, go on a roadshow, wine and dine investors, they find an existing firm and ask to get bought out. On Troika's part, they're happy to absorb a profitable firm since they don't have much else going on. That's why they called it a shell company. So how does Troika, a profitless shell, buy out Converge? Question mark. For the $125 million merger, Troika issued $25 million in restricted common stock, handed over $25 million in cash, and raised another $75 million in debt from Blue Torch Capital, a credit investment firm. Now here's where the fun begins. To entice Blue Torch Capital to fund the merger, Troika Media also gave the creditors $50 million worth of Series E convertible preferred stock. So they made the bankers owners of the company, backed by an equivalent number of warrants. That's around 33.33 million new shares, assuming a $1.50 conversion price. And if TRKA stock fell below $1.50, Blue Torch could convert at 80% of the current market price, subject to a 25-cent floor. In the worst case scenario, that means they could have converted at 100% if it went over under 25 cents. In the worst case scenario, the agreement forces Troika to issue 200 million new shares, a fact that was not lost on Troika's accountants. In April of 22, the firm filed a statement that allowed the additional 200 million new shares. Of course, short sellers see this as an excellent selling opportunity. Duh, they just issued 200 million shares. That's pretty freaking scary. Troika only had 64 million common shares outstanding, making a potential 200 share dilution virtually ruinous to existing shareholders. All short sellers needed to do was to send prices below 25 cents, which they did, and wait for Blue Torch to convert its Series E preferred. I'm trying to push them right out of there, make this thing collapse, and lose their deal. It seemed like a one-sided trade where nothing could go wrong for the hedge funds until Blue Torch failed to convert the shares. So Blue Torch, the people that loan the money, they like this so much, they're keeping it. They're not going to convert the shares. They could just go cash that money right now. They'll still have the loan with Troika. They'll still have to make their payments, or hope they make the payments. But they could just go cash out those stocks right now. They're choosing not to. Why? Probably because they think the price is going to go up. There are many reasons why Blue Torch's management might have decided to snub the short sellers. The most obvious is that converting them into 200 million shares at 25 cents would have saddled the creditors with enormous number of unsellable shares. Most of Troika shares are closely held, so dumping 200 million onto a 32 million free float would have tanked the stock. Remember, Blue Torch is incentivized to sell its shares at a profit. Very important. The second was that Troika was performing well, at least from a fundamental standpoint. In November of 2022, just a few months back, the company reported it generated $6.4 million in operating income for the quarter, Troika's first operating profit since 2007, and Wall Street now expects the marketing firm to generate $35.8 million in operating income by 2024. At that rate, the newly combined firm can repay its $75 million loan within 3 to 4 years and still leave Blue Torch with an additional $50 million in convertible stock. We're not talking about a hyper-growth company here, just one thing that's doing well enough to fulfill its original obligations. Blue Torch has also continued to work with Troika to keep things going. In September of 2022, the two companies agreed to a new Series E agreement that limits dilution to 142 million shares. And despite breaking several covenants, Troika remains in good faith negotiations with Blue Torch. The companies have amended their agreements around 8 times now. So they have a bank, an investment company that's vested in this company. It sounds like they're sitting down at board meetings with them. It sounds like they're getting involved in the business. It sounds like they like what they're seeing here. It's a profitable company, folks. We got to quit pretending it's not. The shorts dove onto this 200 million shares dilution, and they might end up paying for it. It's still over, I think it said 50 to 60% short sold. These people need to get out eventually, and the faster this price goes up, the faster they need to get out. They're going in the wrong direction today. They woke up and said, oh shit, 16.44%. This isn't good. The world is still beating this thing up. In the last month, well, it went up 5%, greatly outperformed the markets. If you look back 6 months, though, that's before the good news started coming out. On more recent charts, you'll see better things. The last week, it took a pounding. In the last month, 4%. Last week, down 27%. Today, 16% of it back again. So it's about back up to a quarter again now. It's up 3.5 cents almost today. What can we expect out of the future? I don't know, but you better grab a few shares. The short squeeze is still on. It's on like Donkey Kong. That is a very good thing for this stock and where it's going in the near term, and the business fundamentals all of a sudden just showed up. They got an investment company that's willing to work with them. They're going to probably have the 200 million shares yanked off by 2024. It's already 2023, folks. We're there already. Just a couple of years, and this thing will be paid off, and this is going to be a good deal. Might be looking at a several dollar stock here coming up pretty soon. But that's why everybody's in love with Troika Media Group right now. That's why it's performing well, and hopefully it will continue to do so. And they made a very, very, very smart merger. They threw all their money on the line, and they bought a winner, and it's a winner, and it's on their books. And sorry, short sellers, but this is what happened. You wanted to keep seeing this, I know. Sorry. It's a real company now. It's not just a shell company. Anyways, just a quick update on Troika Media Group, how they got to where they were and what's expected to happen. I think it just looks like all good stuff to me. It's just going to be solid revenue. It's going to be earnings or near earnings. It's going to be them paying off their debt very quickly. Once they do, they're going to be able to start throwing numbers on the board. It might not be a growth machine because Converge is in the customer acquisition and advertising marketing. I don't know how fast they can grow that thing. I'd like to look at their private numbers to see how they are as a private company. Maybe we can get a better idea for their growth numbers. But we know for now that they're a winning company. We've seen their books on publicly traded company now. These are pretty much Converge numbers that you're looking at here. Oh, excuse me. Here's the income statement. These are the Converge numbers. Right there. Profitable for 6 months. And keep in mind, this is always, they're going to intentionally try to keep this at zero. You're not going to see any earnings out of this company. You're going to see a tiny, tiny earning. Probably for the next 7 or 8 quarters, you're probably going to see a tiny, tiny earning. And the reason is because when they make $50 million for the year, they're going to send it to pay off their debt. They're paying everything off. They're getting out of the hole. They're saving Troika. They're saving Converge. That's the deal that was struck. It's a merger. The Converge staff is fully employed at this company now. It sounds like they're pretty much running the show. They're the ones who run the business that brings the money. But we're going to continue to see this 1.27 million. Don't get confused and think they're going to throw up a $10 million win next year, because they're not. They're going to intentionally keep it at 5 million, 10 million a year in income. They're not going to throw up huge numbers per quarter. They have stuff to pay off, and that's what they're going to be doing with the money. But the important thing is you're going to be able to watch this debt crumble, and this is going to be your telltale for how they're doing every quarter. Oh, sorry, let me get back to here. Almost there. You see the way this yellow line collapses? You're going to want to see that every month. You're going to want to see it go from here to here to here. Assets, they're going to depreciate those probably. That doesn't necessarily mean anything bad happened, but the yellow line is the one we're in touch with here the most. This is their debt. We want to see this get in a reasonable position. Right now it's $176 million. That's what they're going to be paying off over the next couple of years. And we would just want to watch this yellow line come down. Expect the blue one to come a little bit with it. It didn't really fall year over year, but the debt sure did. Actually, looks like it went up a little, 204 to 205. But they will depreciate some of their assets to save money on taxes. So expect a little bit of a fall. That's not a bad thing, but really key in on this number. Their wins, their profit, their future EBITDA as a company, you'll see fall off of this yellow line. So if this quarter it's 176 million, and next quarter this liability line says 166 million, that means that they took $10 or $10 million and they sent it to the credit card company to pay for this thing instead of sticking it here on the income statement to earn an earnings per share and be an even more profitable company. When you see 10 fall off of the debt line, what it means is that they could have put the 10 on this line, the net income positive line, showing a very strong earnings per share. So yeah, they have a couple of years to get through. Do they have the situation in hand? It sure looks like they do. It looks like they have a pile of money to send to their creditors. Their creditors are standing by their side. They're not going anywhere, and the people even could have sold their shares and turned a profit. That was extra money that they got for making this deal. The inducement, they could have sold off that at $1 or 75 cents or 50 cents, or they could have gotten 100% of it for under a quarter, which probably would have been worse than selling it at $1. But they believed in what they were seeing. Blue Torch is a believer. I'm becoming a believer. I see upside for this company. Stay with it. Thank you very much for checking out the video. Continuing cover of Troika in the future. TRKA. I'm James. Have a wonderful day. Please like the video and subscribe.